China's economy is facing a formidable challenge, a deepening crisis in its real estate sector. For years, real estate has been a cornerstone of China's economic growth. Now, that cornerstone is crumbling, revealing deep-seated vulnerabilities. The crisis is characterized by falling property prices, mortgage boycotts, and a string of developer defaults. This has triggered protests, eroded confidence in the financial system, and raised concerns about broader economic stability. The crisis has been years in the making and is a stark reminder of the risks associated with an economic model overly reliant on real estate. To grasp the magnitude of the crisis, it's crucial to understand the outsized role real estate plays in China's economy. Real estate and related industries account for a staggering 25 to 31% of China's GDP. This reliance on real estate far surpasses that of other major economies. It even dwarfs the levels seen in Spain and Ireland at the peak of their housing bubbles. This dependence on real estate has made China's economy particularly vulnerable to a downturn in the property market. The roots of China's real estate crisis can be traced back to two key factors: rapid urbanization and rampant speculation. Over the past few decades, China has witnessed an unprecedented wave of urbanization. Millions of people migrated from rural areas to cities, seeking better opportunities and a higher standard of living. This mass migration fueled a surge in demand for housing, driving up prices. Simultaneously, real estate became a vehicle for speculation. Investors, enticed by rising prices, poured money into the market, further inflating the bubble. This speculative frenzy was exacerbated by government policies that encourage property purchases as a means of stimulating economic growth. The government's emphasis on homeownership as a marker of social stability further fueled the frenzy. Developers, encouraged by the seemingly insatiable demand, embarked on ambitious construction projects, often building more than the market could absorb. This led to the emergence of ghost cities, vast developments with high vacancy rates, a clear warning sign of an impending crisis. The consequences of China's real estate bubble have been particularly severe for young people. Soaring property prices have made homeownership an increasingly distant dream for many young Chinese. The homeownership rate among 25 to 34-year-olds has plummeted from over 70% in 2010 to just 50% in 2020. This stark decline reflects the growing affordability crisis facing China's youth. For many, homeownership has become synonymous with an unbearable financial burden. Adding to the challenges, more than 70% of first-time homebuyers rely heavily on family wealth for down payments. This reliance on intergenerational wealth has exacerbated inequality and made it even more difficult for those from less privileged backgrounds to gain a foothold in the property ladder. The crisis has led to a profound shift in the cultural perception of homeownership in China. What was once seen as an essential milestone and a symbol of prosperity is increasingly viewed as a risky and potentially crippling investment. Section 5. Silenced voices, protests and censorship. As the cracks in China's real estate market widened, so too did public discontent. Homebuyers, who had invested their life savings in properties that were left unfinished due to developer defaults, took to the streets in protest. These protests, fueled by anger and frustration, spread to over 90 cities across the country. Protesters demanded the completion of their homes and accountability from developers and the government. Social media, despite strict censorship, played a pivotal role in amplifying these protests. Platforms like Weibo and WeChat became crucial spaces for organizing demonstrations, sharing information, and expressing grievances. The government, wary of the protests' potential to destabilize the political system, responded with a mix of repression and attempts at appeasement. Security forces were deployed to quell demonstrations, and online platforms faced increased scrutiny and censorship. Section 6. A government in reaction mode. Faced with mounting pressure, the Chinese government has scrambled to contain the fallout from the real estate crisis. Initial responses focused on mitigating the immediate risks and preventing a full-blown financial meltdown. The government urged banks to extend loans to struggling developers, providing them with a temporary lifeline. State-backed funds were also deployed to bail out some of the largest developers, preventing a domino effect of defaults that could have sent shockwaves through the financial system. However, these measures have done little to address the root causes of the crisis. The government's reluctance to provide direct compensation to homebuyers who had invested in unfinished projects further eroded public trust. Moreover, the crackdown on protests and censorship of online dissent highlighted the government's sensitivity to criticism and its determination to maintain stability at all costs. The government's response has exposed a fundamental dilemma: how to navigate a soft landing for the real estate market without fueling moral hazard and exacerbating the underlying problems. Section 7. Cracks in the system, bank failures and financial instability. The tremors from China's real estate earthquake have reverberated through the financial system, exposing vulnerabilities in the banking sector. Several small and mid-sized banks, heavily exposed to the property market, faced liquidity crises as developers defaulted on loans and the value of their collateral plummeted. This triggered a wave of bank runs, with depositors rushing to withdraw their savings, fearing the institutions might collapse. The most notable example was the 2022 Henan Bank scandal, which involved the freezing of deposits and sparked widespread protests. The crisis exposed weaknesses in banking supervision and raised concerns about the true extent of bad debts within the financial system. In response to the growing financial instability, regulators implemented stricter lending standards and increased capital requirements for banks. These measures, while necessary, further restricted credit availability, exacerbating the slowdown in the real estate market. The crisis has highlighted the urgent need for reforms to strengthen financial regulation, improve risk management, and enhance transparency within the banking sector. Section 8. Ripples beyond real estate, a slowing economy. The fallout from the real estate crisis has extended far beyond the property market, casting a shadow over China's broader economy. As the real estate sector contracted, it dragged down related industries such as construction, materials, and manufacturing. The slowdown in these sectors resulted in job losses, particularly in construction, which has traditionally been a significant employer for migrant workers. The decline in economic activity has also impacted local government finances. Local governments in China have long relied on land sales to developers as a major source of revenue. With the real estate market in a slump, land sales have plummeted, squeezing local government budgets and raising concerns about their ability to fund essential services and infrastructure projects. The crisis has contributed to a decline in consumer and investor confidence, both domestically and internationally. Section 9. Charting a new course, reforms and the future outlook. The severity of China's real estate crisis has underscored the urgency for long-term structural reforms. Analysts argue that China needs to transition away from its reliance on real estate-driven growth and towards a more sustainable model. This will require rebalancing the economy by boosting consumption, fostering innovation, and developing a more robust social safety net. Key areas for reform include curbing speculation by implementing measures to deter speculative investment in real estate, such as property taxes and restrictions on multiple property ownership, increasing affordability by expanding the supply of affordable housing options for low and middle-income earners through government-subsidized housing programs, strengthening regulation by tightening regulations on developers, financial institutions, and local government financing to prevent excessive risk-taking and promote greater transparency, boosting consumption by implementing policies to increase household incomes, reduce income inequality, and encourage domestic consumption, and fostering innovation by investing in education, research and development, and high-tech industries to drive productivity growth and create new sources of economic growth. The road to recovery for China's real estate market will be long and arduous. While the government's efforts to stabilize the market have prevented a complete collapse, they have not addressed the underlying structural issues. Reforming China's real estate sector and transitioning to a more sustainable economic model will require a delicate balancing act. The government must navigate these challenges carefully to avoid triggering further instability while laying the foundation for a more resilient and equitable future.